Hey, what's going on, Agents for Life? Can you believe it's been a week? I can't believe it either, but here we are. Podcast number 230. Thanks for coming. Gonna get into some really great mortgage protection stuff. So I'm super pumped. But before I do, a couple of quick things I wanted to go over. First of all, announcements. Okay, we got one big announcement. You've heard me talking. Maybe I didn't mention it recently, but I've emailed a couple of times about it, and you've certainly heard it on the calls. Dallas Leadership Conference, July 22nd. Okay, guys, that's 3 months away. All right, you got plenty of time to write some apps. Dallas is closer. Those of you who are in the area on the west side, guess what? We don't have to fly all the way back east on this one. Plus, we get to go to the headquarters of Integrity. So there's some really cool things planned, and I hope that you can all put it on your calendars and make it. It's just an overnighter, so it's one night in a hotel, or if you fly out early enough, you can even do a same day trip. But I hope you can all make it. This is where all the leadership is coming together for a day to do some leadership training. So whether or not you're a leader now doesn't matter as much as what you're going to be, what you're planning on being. So if you're planning on being a leader, you need to be there. Number two, a mic drop thought. So get this, my wife and I were just kind of chatting back and forth, and this came up. Very interesting is that what we concluded in our conversation was that the more true you are to your authentic self, the more divisive you're going to be to the rest of the world. Now look at all the big leaders, all the big examples. They don't have everybody loves them, and I even referenced Jesus Christ himself. I'm like, he was probably the most. I don't want to say divisive because that sounds like a name calling, but his personality divided the people. He had haters and he had just very very devout followers, and because he was probably the best example of being true to himself. But you look at any major leader out there, any major influencer, they are the ones that are true to themselves. They've got haters and they've got followers. And it just goes back to not trying to please everybody, because when you try and please everybody, you end up not pleasing anybody, including yourself, because you're not living true to yourself. So my mic drop message this week is you be you. Okay. Don't try and be someone else. There's some really great leaders in this industry, but you are the only one that is the best at being yourself. So bring that to the table. That doesn't mean rewrite the scripts and totally redo all of our presentation materials. Follow the system, but be yourself. Okay. And you're going to have some clients that say no. You're going to have some clients that say yes. You're going to be divisive, right? You're not the right fit for everybody. You might be an acquired taste. I don't know, but be yourself, be your authentic self. Okay, cool. Let's jump into the training. Now, it's been a while since I've talked about mortgage protection, and it's occurred to me talking to some of you that we're so focused on ethos that we've kind of cast mortgage protection by the wayside. So I'd like to start bringing it back. Why? Because we have more leads on the mortgage protection side. And those are actually, well, I guess it depends, because I've got some agents on our team that are doing really, really well with ethos. So if you're rocking the ethos world, keep doing what you're doing. If it's working, don't switch strategies because I did a podcast on mortgage protection. But if you're considering changing things up, I want you to listen. Or if you're considering adding mortgage protection and maybe you haven't done much of it. Okay, mortgage protection is very simple because we know the purpose. We already know why. We need to build value in that why. But an ethos lead, we got to find out why. So mortgage protection, we already have a topic. The goal is to protect the mortgage. Okay, you can just assume that until they tell you otherwise. But there's three strategies that are in the presentation. If you download the presentation, you'll see there's a strategy for younger people, middle-aged, and older people. And I'm going to go through those real quick for you, just so you understand how they work. Because mortgage protection, when served up really, really simple, can be a very easy thing for people to buy. They just want to know that you're legit. They want to spend a little bit of extra, 60, 80, $100 a month to protect their mortgage. Okay. For most people, that makes sense. We just have to be careful that we don't oversell them, give them too much information and confuse them or overwhelm them, similar emotions where they shut down and they just don't want to buy. So they want to wait because they don't want to make the wrong decision. If they have too much information, they're worried about making the wrong decision. So they don't want to buy. And that's true with any appointment, by the way. So you can apply that to your ethos appointments or mortgage protection, final expense, whatever you're doing. Keep on the topic the reason why they're talking. They filled out the form, submitted the request. The reason why you're together, stay on, find out the topic, and then stay on the topic and don't veer from it. Keep your presentations simple and focused and streamlined. So mortgage protection, that's the topic right now. Number one, you're going to come across young people. Okay, this is the 20 to 30-year-olds. Okay, these are the hardest and the easiest. The easiest in that these are super inexpensive. Okay, the policies for a 20-something or a 30-something term policies are super, super inexpensive. So what I like to do, well, I'm presenting the whole mortgage. Usually the mortgage is going to be 300, 400,000, something like that. Out here in Arizona, other areas of the country might be 2 or 300,000 for a starter home. Home prices have been going up, but for a young person, they can get that much for what? 20, 30, 40 bucks a month, depending on their age, health, smoking status, whatever. So super easy. You're going to pay out the whole thing. If you die, you get a check for the whole mortgage. If she dies, you get a check for the whole mortgage. We're done, right? It's really simple mortgage payoff, mortgage protection, boom, right? Super inexpensive. Why I say it's also the hardest sell is because this demographic is the hardest to really catch the vision of what mortality is all about. They think they're going to live forever. And so they're not really motivated to buy life insurance. Life insurance is for somebody that's old, is what they think, right? So getting them to really see the value is its own challenge. But if you can get somebody on, great strategy for them isn't just term, but return of premium. And this fits into why they think they're going to live forever, right? If you're going to think you're going to live forever, guess what? I got a policy that will pay back all of your premiums. You go to America, the 100, the HMS series 100, and it has 30-year and 20-year cashback option. You have to have E&O insurance to ride America, but you can talk about a policy that, if approved, in 30 years, they'll get all that money back. And it's a really popular strategy for the younger demographic who thinks they're going to live forever. So how would you like a free policy? You're going to pay for it now, but you're going to get it all refunded if you outlive it. So it's either going to pay out if you die, or it's going to pay out if you live long and be healthy. Either way, it's paying out, right? So in that regard, it kind of sounds like a whole life, right? A whole life is going to pay out no matter what. But this pays out at the end, all dollar for dollar, all your money back. American Amicable has one that pays out 75%. So it's a little bit of a compromise, also a little bit less expensive. Okay. So if you're talking to a younger person, that's the goal. That's the strategy. Middle-aged person, not so easy to cover the whole mortgage. These are the 40 to 60-year-olds. Okay, they're going to be, it's going to be quite expensive to try and cover the whole thing. I'm usually looking at a 20-year term because that gets you through most of the mortgage. Okay, and the mortgage is paid way down in 20 years. And besides, a lot of people are putting a little extra towards their mortgage, and it's probably not going to go all 30. Maybe it'll be 25 or something like that. But 20-year term is pretty good, usually for that demographic, and that's when they can convert more later to whole life. But we're looking at covering half of the mortgage or thereabouts. And if you've got somebody in a $350,000 policy or a home mortgage, then I'm going to be quoting, 100, 150, and 200. So we're hitting that mid-range. Okay. So yes, it does not pay off the entire mortgage. However, you probably don't need to. And here's why. 40 to 60-year-olds, you probably have both spouses working. Okay. Double income in most cases. And if it's not, it's okay. But because you build value in what that does. So let's say that you have a mortgage for 400,000 and you have a mortgage protection policy for 200,000. Well, that payout gives you the ability to write a check for half of that mortgage, refinance it in a much, much lower rate, and the surviving spouse could probably afford that on their income. Now, if they can't, they can make payments on the mortgage for 5, 7, 10 years. Okay, if you have 200,000, that can last quite a while, right? Where they can go back to school, if they need to redefine their career, if they need to just some time to get into their careers where they can make more money, finish raising the kids and sell the house. They just have lots and lots of time before they have to make any important decisions. So that house is locked in either way. So these are the strategies I'm talking through with people in their $40 to $60 or 40 to 60-year-old range, because we're trying to keep prices affordable in mortgage protection. And the affordable means, $60 or $80 on up to $100, $150. $200 starts to get unaffordable for most people. So those are the ranges that I want to be showing pricing in. And when you're 40 to 60, a 20-year term, those are just going to be a little bit pricier than when you were in your 20s and 30s. So the natural strategy just becomes to back off the death benefit and cover half of the mortgage or thereabouts. Okay. Now, strategy number 3, when you're talking to an older person, and I'm going to say 60 plus, okay, these are not cut and dry rules. Sometimes this strategy applies to someone in their 50s. Okay. Not usually younger than that, but sometimes. But you can, and sometimes people are very healthy and it makes sense to get something different. But generally speaking, older folks will have a much, much harder time getting qualified for term coverage. So they have to get what we call final expense. Well, how do you justify the value of a final expense policy to somebody that's 65 or 70 years old? Well, their mortgage is $300,000. Okay, they're not getting a policy that's going to pay off the mortgage. Okay, we need to make that point first of all. But what I like to say is the phrase, your people in your demographic, or most folks that are in your walk of life, are doing this strategy. And here's why. It doesn't make financial sense for us to try and get this monster of a policy to pay off the whole mortgage, because as you know, the older you age, the more cost life insurance becomes, the more expensive it becomes. So here's the strategy that'll work for you that's a lot more affordable, is we're going to protect that equity. In the intake, you want to write down the equity. Nick Burns talked about it just on the team call this week. He circles it. How much equity do you have in your mortgage or in your property? 300,000, 200,000, whatever it is. Oh, that's awesome. You compliment and you circle that because you want to bring attention to the value that mortgage has, that equity that can pay out to the loved ones. So essentially, if you've got 100,000 or 200,000, that's like a life insurance policy. They just have to be able to sell the house or refinance the house. Either way, to sell or refinance, you have to have a little bit of money. Why? If you're selling, you've got to keep making the mortgage payment. If you refinance, you have to have some money to qualify. So either way, you want to put your spouse or loved ones in a position of financial strength to be able to make those decisions. So here's what we're going to do, Mr. Jones. This is the strategy for somebody in your age, okay? We're going to put a policy in place that will give Mrs. Jones enough money to keep making the mortgage for 6 months, 12 months, 18 months, until she gets through the funeral and gets through all the things that a person has to go through when they lose a loved one, without any fear or without any worry of losing the house. After that, go through the things, kind of figure out what plan B looks like. Are we going to sell? Am I going to rent? Am I refinancing? What am I doing? We have time to now make it in a much better frame of mind. Why? Because we have money to make that mortgage payment. 6 months, 12 months, 18 months. How many months would you like to pay? Or would you like to prepay so that your spouse has that much time? Time is more valuable than money. So when you're talking about this strategy, you serve it up in terms of time. So here's the plan for 6 months. Here's the plan for 12 months. And here's the plan for 18 months of mortgage payments. Which one makes the most sense? Okay. When people understand the value of what a policy can do in that light, it makes much more sense, because those plans are so much more affordable than trying to get the entire mortgage paid for. And we call it an equity protector strategy. It's very simple, and it's using math in a way that people a lot of times don't think about. And they can cut costs and make mortgage protection much more affordable than they otherwise could. So use some of these principles, maybe not my exact words, but if you understand how it works, you can use your words in your next presentation to talk people through these strategies to help them understand the value of what a mortgage protection policy can do. Remember, when someone buys a home, it's their most valuable asset. And to protect it for $60, $80, $100 a month is well worth the investment. People just need to see the vision, and it's our job to explain it in a very simple, clear, concise manner that brings value to the table so they understand what that payment is doing for them and their family. I hope this helps. We're going to talk more about mortgage protection in the podcasts to come, more good sales things coming up, and more ways that we can help families and protect families and help them understand the value of what we sell. Thanks for listening. Go out and make it an awesome week for yourself. And I can't wait to see you on the next team call. Take care. Bye.